Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up for you to watch. Now, if you're not on my email list, it's completely free, and to join it, just go below this video, and if you're watching on YouTube, and you'll see a link where you put in your email address, and in the morning before the opening bell, you'll get an email from me with my analysis of the markets and the top headlines today I think you need to know about. We're in an interesting week, to say the least, when it comes to the stock market. We've seen a sharp decline in the NASDAQ, many technology stocks. But there's a potential base building short term that has been built, and a chance for the bulls to take control, at least for a couple of weeks here. And this week will tell us whether they can do that, or whether this is just another one of the false moves. Now I'll give you my opinion on that in a few moments, and I'm also going to talk about a fund that I actually bought last week that pays a 10% dividend. Now I am hopeful that we can get the bulls to break out the market to the upside. But that said, I want you to know that I base my analysis on the charts and the trends, which we'll go over. And this isn't, so I've been someone that's been bearish on the market and still think there's tremendous problems with it. And that's not a popular opinion. And I adjust my opinions to what I see in the chart. So this week, I'm going to show you that I think we can break out, and that would set the stage for a rally for a couple of weeks. But this is basically the first time I've been, somewhat positive in the market for several months. And this is not a popular, it has not been a popular message on YouTube. Frankly, most of the stock market videos on YouTube are people always bullish on the market and just making these crazy predictions about the stock market with using technobabble talk. The biggest person on YouTube when it comes to financial markets is Cathie Wood. And all she does is make these crazy predictions that don't come true. She got a huge following in 2020 when her fund went up. But then when it peaked in February last year, she just continued to make these predictions of, inflation's going to go away, and it didn't. And she's still doing it. But what's important is that there are dozens, if not hundreds, of people on YouTube that have gotten themselves a following by basically copying her or praising her all the time. And that has worked, because that's what people want to hear. They want to hear reasons to think that the stock market is going to go up all the time. And they want predictions that back that up. And if it's not the stock market, then they want to hear how they can get rich in a crypto coin overnight. And it's all unrealistic. It's all a lot of hype. And I say this because I want you to know that while I am more positive on the stock market at the moment, and the stock market's going to have to prove me right or wrong on wanting to be more optimistic, this is the first time I've been like that for quite some time, despite the fact that just about everyone else you see on YouTube is always positive on the market, the people that got the biggest followers. So all that said, let's get to the analysis. Let's look at the charts, and let's examine what the Federal Reserve did while they raised interest rates that is actually getting the bulls buying stocks, despite the fact that they projected about 9 interest rate hikes. So how can it be that interest rate hikes for the moment are exciting people? Let's break everything down. So I got to show you my charts here. And This is the S&P 500. And you can see how it has a really simple downtrend line. I just drew on it, and it went through it on Thursday. And a lot of stocks have this similar setup. Now, you can see these retracement levels. We've gone through the 1/3 retracement level, and we're now at the 50% retracement level. What this means is the S&P 500 closed right on the point where it is rallied enough to take back half the losses. It closed right below its 200-day moving average, below its 150-day moving average, above the 50-day. Now, it had a similar rally at the end of January that lasted in February, and then things rolled over. So it's possible that's going to happen again, that this is a trap and the market will just drift for a week or two and then start going back down. That's the bearish scenario. The bullish scenario is that this ride is going to have more legs on it for the next couple of weeks. And I think there's a good chance that that's the case. I think that's the more likely scenario, but the market will have to show us. One reason I think that is charts such as this one, which is the percentage of stocks above or below their 200-day moving average that trade on the New York Stock Exchange, kind of formed a base and is turned up. And this could rally, up to the 55 to 60 area, which would suggest that the stock market would rally too. I mean, it would if this is what happens. Now, I was somebody, while everyone else was bullish all of last year and, failed to predict the decline, I was warning about it, that the market would have some sort of pullback, a likely start of a bear market. And the reason why is, well, one of the key reasons is this indicator. It peaked in June and began to go lower, while the stock market averages, in particular the S&P 500, continued higher. And that's a classic negative divergence. What it meant was more stocks inside the stock market were falling than going up, and despite the fact the S&P was continuing to go higher. That's a classic warning sign that you're entering the bull market, or at the very least going to start a big correction. And that's what happened in 2015. It's what happened to a lesser extent with this indicator in 2018. But it was a massive red flag. And I pointed it out repeatedly, while the Cathie Woods of the world ignored it. So again, repeat, I'm someone who goes with the trends of the market, and I'm willing to adjust my opinion based on that, and not simply telling people what they want to hear. Now, despite the fact that I think that the S&P and the NASDAQ and the Dow and the averages could, trade up for the next couple of weeks, that does not mean I think the future of things like the ARK ETF has changed. In fact, anything trading this far below the 150-day and the 200-day moving average is not something I would buy, even if I thought the stock market could rally for a couple of weeks. And the reason I say that is because if you want to beat the market, the way to do it is to buy things that are outperforming the stock market averages. And ARK is not doing that. ARK is trading much worse than stock market averages and is going to continue to do that going forward. Nothing has fundamentally changed in the financial markets, in the macro trends, that changes the story for ARK and stocks like it, or stocks that are inside of it. So what you still, I believe, should do, and I'll show you how I'm doing it, is focus on buying and holding asset classes, exchange traded funds, and stocks inside of sectors that are outperforming the S&P 500 to beat the market. That's just common sense investing in trading. And obviously, one of those things that have been doing it has been gold stocks. And I have GDX in my retirement account and many mining stocks in my main account. And, trading well, GDX, the ETF, is trading well above its 200-day moving average. One of the stocks inside it that I own is Newmont, vastly outperforming the stock market, vastly outperforming the ARK ETF. In commodities, and this is one of the ETFs I own, has been doing the same thing. It's been a much different, feel to be holding something like DBA, that's been not very volatile and on a steady rise, than something like a Bitcoin focused stock like Riot Blockchain. Now Riot Blockchain, yeah, it's got a potential short-term bottom pattern and could bounce, if it can clear the February high, could easily go to 27.5 or 30. But if it does, you'd have to sell and get out, and it could just as easily, not do that. It's not you. It's more of a gambling situation. Or if you buy something like Newmont, you can say I can put a stop loss below 70 or 68 if I want to give it more room, and this is likely to go up, and remain one of the best performing stocks in the entire S&P 500. It is inside the S&P 500 for the rest of this year. And one of the things about gold and silver is historically they go up when the dollar goes down and go down when the dollar goes up. But they're so bullish now that they've gone up this year when the US dollar index has gone up. And now I think the US dollar index can actually pull back a little bit, which would also be bullish for gold and silver. Now, the Swiss franc, for example, there's many currencies that look like they want to at least bounce. And that's why I think the US dollar index could go down. The Swiss franc is one of them. The Japanese yen hasn't really, gotten more positive, but the euro had a sharp sell-off. It looks so oversold that it could go up. One of the most bullish looking currencies now is the Australian dollar. And look at this ETF that's for Australia, trading much stronger than the S&P 500. It's above its January high, above its 200-day and 150-day moving average. So I would rather buy an ETF like this than to try to buy the ARK ETF or buy a crazy stock like Riot Blockchain. I'd rather buy something outperforming the stock market. And so last week, when my opinion began to shift about the market, I started to think, okay, this could turn into a rally that could last for a couple of weeks, be better than the one in February. And if it does for the S&P 500, who knows? This thing could, I can't predict where such a rally would end. It's going to have resistance at the two-thirds retracement level, which is at right above 45.50. I think it's 45.60 or the February high. But this could get going. The S&P 500 could get going and get up to 4,700, maybe even higher than that. I cannot predict it. I don't try to predict it because it's impossible. I just go with the flow. And there's, the short term, the bulls have the ball. It's how much can they run with it. And if they do run with it, the stock markets around the world and the sectors that are outperforming the S&P 500, they should go up more than the S&P 500. So that's what I'm focused on with stocks and stuff I want to hold or things I want to buy. Not, can I, play something that is that was, lagging, or an ETF, like this, this is lagging so bad. It was red hot for people to get into this in years past. Canopy Growth was one of the most popular stocks to own on Robinhood. It was #1 at one point in 2019 and remained a real popular stock in 2020, but it's one of the worst performing stocks in the entire stock market. I do not try to bottom guess, stocks deep in a bear market, which, even if you don't think the S&P 500 is, this is the entire marijuana cannabis sector deep in a bear market. I would avoid it at all costs and focus on energy, focus on mining stocks. And, I took a trade to see what will happen, to put some more long exposure in my account with Australia. Now, I didn't do it with this ETF. I went and looked what's inside of this ETF and what other ETFs or funds are there out there that might be even better than this one. And I found one that I bought, and I'm going to show it to you. And it's the First Australia Fund. And I bought it last week, and it's paying a over 10% dividend. So that's huge. And I like the holdings in the fund because they also align with what I'm macroly bullish on: energy, commodities. The inflation trend is real, and this fund is invested in alignment with it. And let me show you. It's small. It only has, $142 million in assets. But here's, you can go to the website, aberdeeniaf.com, to find out more about it. But if you look at the top holdings, BHP Group is the top holding in the fund. That's one of the biggest commodity mining energy companies in the entire world. And it pays a nice beefy dividend. And it's got some Australian bank stocks, material stocks, real estate stocks, energy stocks in it. So I like the way this fund is invested. It's not invested in Facebook. It's not invested in, cannabis stocks deep in a bear market. It's not invested in the type of crap stocks the ARK fund holds. These are investments that the sectors are, the majority of the sectors in this fund are bull market sectors. In fact, I own the BHP stock individually in my main account too. I like it that much. I've been owning it for quite some time now. I think perhaps 2 years at this point, or close to it. But anyway, this is one of the things I bought last week as a way to potentially play a rally. Now, the market, just stalls out and turns down, then I may sell it, to reduce my long exposure. But I bought this IAF ETF. That's not the ETF here, but it's right there. Now, I want to talk about why, let's look at the Dow. So you can see that, same story with the Dow, the Russell 2000, very similar chart to the percentage of stocks above the 200-day moving average, which that looks like, frankly, it could bounce up to 55.60, which would be similar to this bouncing back up to 220 or maybe 230. That's if the rally really turned into one that can last into May or June even. We'll just see. But what could drive the stock market rally? What's the reason for it? Well, one of the things that happened, and would that rally turn into a giant bull market, that goes up for the entire year? Well, to answer that, let's look at the reason why, the justification that a lot of people all of a sudden are giving to buying stocks. you know, so this year, the worry was inflation. Inflation means we got a 7.9% annualized CPI in the last report. And historically, to stop inflation, the Federal Reserve has to raise rates above the rate of inflation. I pointed this out in a chart last week. That's what's always had to happen. And if the Federal Reserve raises rates over 8%, obviously that's going to hurt a lot of stocks because that raises the borrowing costs for corporate America. So stocks that would be hurt the most, the companies that would be hurt the most, the stocks in them have been among the worst performing stocks in the market. Technology stocks, airline stocks, stocks of companies that go heavy in debt, stocks that can benefit from inflation, actually have been the ones that have done the best. Gold, real estate, energy, materials, stocks, REITs, when I say real estate. So, but that's a segment of the market. The overall market, higher rates are very troubling. And that's been a reason why people have been selling stocks. But what the Federal Reserve did at the meeting last week was they released, after saying they're raising rates, they released this statement. You're looking at it right here. I'm showing it to you right here. And in this statement, this summary of their predictions, they projected that they gave these projections for the next 2 years, and they predicted that they would have rates at 1.9% by the end of the year. Inflation would come down to 4.3%. So it would come down from where it is now. But the magic prediction is next year. They predicted that they would raise rates up to 2.8%, and inflation would come down to 2.7%. And then 2024, it would come down lower, and they would not raise rates anymore in 2024. And then they would start to lower rates after that down to 2.4%, and inflation would fall to 2%. In other words, what the Federal Reserve did was they predicted something that's never happened before in as long as the Fed has existed, when inflation has shot up as high as it has. They predicted that they would only have to raise rates up to 2.8% by next year, and that the CPI rate, the inflation rate, would then magically decline down to 2%. That is a perfect world, in a world in which bulls will not have to really worry about high interest rates. Yeah, interest rates of 2% or 3%, quite frankly, are not that high. Zero is super low. They should be a couple percent at least. But if history repeats and as it always and has, then they need to raise rates above the CPI rate. But no, they're predicting that the CPI rate will magically go down. So they predicted this perfect world for the bulls, and people are grasping onto that and buying stocks as a result. Now, I would like to step back and tell you that last year, that last year in the first quarter, the Federal Reserve was also making a similar prediction. They said that the inflation would appear in spring, summer, and then just magically go away. If you can remember, the word that they were saying was transitory. They were saying that inflation would vanish in the fourth quarter of 2021. And it did not. When the fourth quarter of 2021 came, inflation did the opposite. Instead of vanishing, it accelerated and picked up. But Cathie Wood, when her fund peaked in February 2021, repeated over and over again the Federal Reserve predictions as if they were a certainty, and said, you need to buy the fund because inflation is going to vanish. And she claimed it was going to vanish because technology would make it vanish. The Teslas on the road would make it vanish and things like that. Did not happen. So we're now once again kind of repeating what happened in the first quarter last year, where there was a dip in the market last year in the first quarter too. This one much bigger, much more meaningful. But the Fed predicted, yeah, you see the inflation, it's going to go away. It's going to go away. Now they're saying it's going to go away next year, but even showing they're even predicting it will start to decline this year, but really vanish by the end of 2023. And people are buying stocks based on that prediction. Now, I would say that this prediction is extremely unlikely and has no real basis in reality to think it'll happen. And when that becomes clear to people, and it's not right now, that will, I think, drive the stock market back down into a bigger decline than the one we just saw. Now, this will, hopefully the market does rally this week. And I don't need to, I won't be talking about that scenario for later on, but it will come back. So let's hope the bulls can take the market can take control of the market for a period of time here, provide some excitement and relief for people. No one likes to hear about stock market declines. Everyone likes to buy stocks, and buy more of them and more of them, and see the stock market go up. Now, I tried to help people do that even when the stock market goes down, because there are things that go up. And if you can focus on what is outperforming the market, you can actually make money when the averages go down, because energy stocks went up in this quarter. Gold stocks went up in this quarter when everything else went down. And my assertion is to continue to focus on things that few people that are beating the market. I would contend with you that Australian fund that I showed you is highly likely to beat the performance of the ARK ETF and the S&P 500 for the rest of this year and probably for the next couple years. And that's why I bought it. I'm not, trying to day trade, jump in and out, but I positioned myself in that. I want to see what it does over the next couple of weeks or months, and then I'll take an analysis of that position. So all that said, if you like this video, please click like, because that tells YouTube that, look, there's value in these videos, and that the algorithm knows that 90% of people that are interested in the stock market, they want to hear Cathie Wood type talk. They want to hear the techno babble. They don't really want to hear about trend analysis of the type I do, where someone adjusts their opinion to what's going on. They want to hear someone bullish all the time, who never warns them when there's warning signs in the market. When I started talking and showing about the internals of the market declining last summer, my views on YouTube began to collapse, because people would tune out of the videos. They didn't want to hear that. And YouTube algorithms said, oh, these are things people don't want to hear. And it just made my views crash. So let YouTube know that there's value in these videos. Click the like button. And if you're brand new to my videos and you want to get the next one, hit subscribe and then hit the bell, and YouTube will send you a notice as soon as the next video is up. So let's see what happens this week. Let's see if we can get the averages to go up a little more. They don't have to go up tremendously. Just look, halfway decent, let's say, not, like they did in the first half of February by the end of this week. So let's see what happens. And I'll be talking with you later on.